Imagine you found $1,000 in an old jacket pocket. Free money, right? Now imagine someone quietly took it back out of your bank account over the last 12 months, a little at a time, so slowly you never even noticed it was gone. That's not a hypothetical. That's roughly what happened to the average saver last year. No one broke into your account. No one sent you a warning email. But here's the catch. Your money is worth less today than it was a year ago, even if the number on your screen never changed. This is one of the strangest things about personal finance. You can lose money without a single transaction ever taking place. Let's be honest, most people go their whole lives without truly understanding how this works. So today, we're going to fix that. Why should you care about this? Because inflation isn't some abstract economic term reserved for news anchors and central bankers. It's the single biggest reason your savings account might be failing you right now, even while it shows a safe, growing balance. Think about it this way. If your paycheck stayed exactly the same for the last 3 years, would you say you got a raise? Most people would say no, obviously not. But if your paycheck stayed the same while everything around it got more expensive, you didn't just fail to get a raise, you actually took a pay cut. You just didn't feel it happen in real time. That's exactly what's happening to money sitting in low-interest savings accounts everywhere. And once you understand the mechanism, you'll never look at your bank balance the same way again. So what exactly is inflation? In the simplest terms, it's the gradual increase in the price of goods and services over time, which means the same dollar buys you less than it used to. Here's the thing. Money itself has no fixed value. A dollar is just a claim on stuff, food, gas, rent, a cup of coffee. When there's more money circulating in an economy relative to the goods and services available, prices tend to rise. That's inflation. When there's less money relative to goods, prices can fall, but that's much rarer. Think of it like a birthday party with one cake. If 10 kids show up, everyone gets a decent slice. If suddenly 50 kids show up and the cake stays the same size, each slice gets a lot smaller. The cake, that's the actual goods and services in the economy, didn't grow. But the number of people trying to get a piece of it did. Money works the same way. When there's simply more of it chasing the same amount of stuff, each dollar buys a smaller slice. Now, inflation isn't inherently evil. A small, steady amount of it, economists usually target around 2% a year, is actually considered healthy for an economy. It encourages spending and investment instead of everyone hoarding cash under a mattress. The problem starts when inflation runs hotter than your money is growing. Here's where it gets uncomfortable. Let's say you have $10,000 sitting in a savings account, earning 0.5% interest, which, by the way, is close to what most big traditional banks actually offer. Over 1 year, that account grows to $10,050. Sounds fine on paper. But if inflation that year runs at 4%, the real purchasing power of your money didn't grow at all. It shrank. In real terms, that $10,050 can now only buy what roughly $9,650 could have bought a year earlier. You didn't lose money in your bank app. You lost money in the real world in rent, groceries, gas, everything you actually spend money on. This is what's sometimes called invisible loss. There's no red number, no notification, no dramatic chart crashing downward. Your balance keeps ticking up. But your buying power is quietly leaking out the back door the entire time. And that's actually the whole point of understanding this. The danger isn't the market crashing. The danger is doing nothing and calling it safe. This isn't just a theory, it's measurable. According to data tracked by the Federal Reserve and U.S. Bureau of Labor Statistics, average annual inflation in the U.S. has hovered around 3% historically, with sharp spikes above 7–8% in recent years like 2022. Meanwhile, the average savings account interest rate has often sat well below 1% for over a decade, according to FDIC data. Do the math on that gap, and you start to see why so many people who consider themselves cautious savers are actually losing purchasing power year after year without realizing it. Let's make this tangible with a character. Meet Alex. Alex is disciplined, saves diligently, puts $500 every month into a regular savings account, and avoids the stock market because it feels too risky. Over 20 years, Alex deposits $120,000 total, And thanks to modest interest, the account grows to around $135,000. Now meet Jordan. Jordan puts that same $500 a month into a diversified index fund, averaging a historical 7% annual return after inflation. After 20 years, Jordan's account isn't $135,000, it's closer to $260,000 in today's purchasing power. Same discipline, same monthly amount, nearly double the real wealth. The difference wasn't effort. It was understanding where inflation quietly eats away at safe choices and where growth can actually outpace it. Now that might sound like an obvious argument for just put everything in the stock market, but it's not that simple, and I want to be honest about that. Savings accounts still serve an important purpose. Your emergency fund, the money you might need on short notice for a job loss, medical bill, or car repair, should generally stay somewhere stable and accessible, even if inflation nibbles at it a little. That's the trade-off you accept for safety and liquidity. Chasing higher returns with money you might need next month is its own kind of risk. The real issue isn't savings accounts existing, it's using them as your only strategy for money you don't need for 5, 10, 20 years. Does it really matter if a small portion of your cash loses a bit of value while sitting in a checking account for convenience? Not really. What matters is your long-term wealth, sitting untouched, slowly losing ground to inflation for decades because it was never given the chance to grow. And remember, past performance of index funds or any investment doesn't guarantee future results. Markets can be volatile, and inflation itself isn't perfectly predictable either. So here's what you can actually do with this information. First, separate your money by purpose. Keep 3 to 6 months of expenses in an accessible, stable account that's your safety net, and inflation risk there is an acceptable trade-off. Second, for money you won't need for several years, look into vehicles that historically outpace inflation over time, like diversified index funds. You don't need to pick individual stocks or time the market perfectly. Consistency matters more than precision. Third, and this is the one people skip, actually check your numbers. Look at your savings account's interest rate, then compare it to current inflation figures, which are published monthly by government statistics agencies. If your rate is meaningfully below inflation, that money isn't just sitting still. It's shrinking in real terms, even while the balance grows. This is exactly why understanding inflation isn't optional trivia. It's the difference between money that works for you and money that quietly works against you. If this changed the way you think about your savings account, that's the whole point of this channel, making the invisible parts of money visible again. If you enjoyed the video, please like and subscribe, and I'll see you in the next one.